when the system finally stopped, it almost took everything with it. It was 1:45 in the morning on a Monday, September 15th, 2008. In the corridors of one of Times Square's most iconic buildings, exhausted lawyers were signing the final documents. Outside, New York slept, unaware that when it woke up, the world would be different. Somewhere inside that building, 158 years of history were being buried with the stroke of a pen. Lehman Brothers, the fourth largest investment bank in the United States, with $639 billion in assets, had just filed for bankruptcy. This wasn't an accident. It wasn't inevitable. It was a series of wrong decisions made by men who believed they knew exactly what they were doing. This is the story of how pride, politics, and 48 hours of failed negotiations broke Wall Street. To understand what was lost, you need to understand what Lehman Brothers actually was. The story begins in 1850 in Montgomery, Alabama. Three German immigrant brothers, Henry, Emmanuel, and Meyer Lehman, opened a small general store. But it was cotton that changed everything. Local farmers began using the shop as a trading post, paying off debts with bales of cotton. The Lehmans realized there was more money in the middle of the trade than at either end. They abandoned the dry goods. They became commodity brokers. That was the beginning of an empire. Over 158 years, Lehman Brothers survived the American Civil War. It survived the crash of 1929 and the Great Depression. It survived 2 world wars. It survived financial panics, credit crises, bubbles, and recessions. Every time Wall Street shook, Lehman stayed standing. Over time, the bank grew, from a cotton brokerage to a commodities bank, from a commodities bank to an investment bank. By the mid-20th century, Lehman was helping finance some of America's greatest companies, from retail chains to Hollywood film studios. By 2007, it was the 4th largest investment bank in the United States. $639 billion in assets, 25,000 employees around the world, offices in New York, London, Tokyo, a reputation built across a century and a half, and at the helm of all of it, one man, Richard Fuld. Fuld had joined Lehman as an intern in 1969. He had climbed every rung of the company. Wall Street called him the gorilla for his intensity, his aggression, his refusal to back down. He had transformed Lehman from a near-dead firm in the early 1990s into a Wall Street powerhouse. Fuld loved Lehman. And for a long time, Lehman loved Fuld back. But 2007 was coming, and with it, a storm neither of them was prepared to face. To understand Lehman's fall, you need to understand what was happening to the American housing market. Between 2003 and 2006, the United States lived through an unprecedented real estate boom. Home prices rose every single month. Anyone could get a mortgage, even without documented income, even without a down payment, even without a credit history. Banks called these loans subprime. Translation, high-risk loans for high-risk borrowers. But Wall Street had found a way to turn those bad loans into gold. The scheme worked like this. Banks took thousands of those risky mortgages, bundled them together into a financial product called a mortgage-backed security, or MBS. Then they combined those MBS into even more complex products called CDOs, collateralized debt obligations. These products were sold to investors around the world, carrying AAA ratings from the major credit agencies. AAA meant, this is as safe as a US government bond. Spoiler, it wasn't. Lehman didn't just sell these products. Lehman dove headfirst into them. Between 2003 and 2007, the bank accumulated more than $85 billion in real estate-linked assets. And to finance that bet, it used a dangerous strategy: extreme leverage. Here's what that means in practice. For every $1 of its own capital, Lehman held $30 in assets, a ratio of 30 to 1. That works brilliantly when markets go up. You earn 30 times the gain. But when markets fall just 3%, you're insolvent. In 2007, the housing market began to crack, first slowly, then faster. Default rates on subprime loans exploded. Home prices stopped rising. Then they started falling. The mortgage-backed securities, which everyone had said were safe, began losing value. First 5%, then 20%, then 40%. Lehman was holding billions and billions in those assets, and Fuld, the man who had built that empire, refused to admit there was a problem. In March 2008, Wall Street received a warning it couldn't ignore. Bear Stearns, one of America's oldest investment banks founded in 1923, was dying. For decades, Bear Stearns had been considered practically indestructible. In 1998, when the Russian debt crisis and the collapse of long-term capital management had rattled the markets, Bear Stearns had survived. It was a tough bank. But the subprime crisis was different. Bear had overexposed itself to mortgage assets. When those assets started collapsing, confidence in the bank evaporated overnight. Clients ran to withdraw their money. Counterparties refused to lend. Within days, a bank with decades of history had run out of cash. On March 14, 2008, the Federal Reserve and the U.S. Treasury stepped in. The Fed provided $30 billion in guarantees to facilitate the sale of Bear Stearns to J.P. Morgan Chase. The price? $2 per share. That's right, $2. In 2007, Bear Stearns stock had traded at $170 a share. The message was unmistakable. Investment banks could die. They could die fast, and they could be sold for almost nothing. Richard Fuld watched all of this and reached the wrong conclusion. Lehman is stronger than Bear Stearns, he said internally. We're not going to be next. And he genuinely believed it. Lehman had a different portfolio, he said. Lehman had better relationships. Lehman was more important to the financial system. Lehman was special. But the numbers didn't lie. In the second quarter of 2008, Lehman reported a loss of $8 billion, its first significant quarterly loss in years. The stock, which had reached $86 in 2007, was in free fall. $60, $40, $15. Investors were leaving. Clients were leaving. Credit rating agencies were threatening to downgrade Lehman to junk status. The bank was bleeding, and time was running out. Between June and September 2008, Lehman Brothers had multiple opportunities to save itself. Every single one was wasted. The first offer came from Korea. In June 2008, the Korea Development Bank, the South Korean government's development bank, opened negotiations to acquire a significant stake in Lehman. The KDB was genuinely interested. They had the capital, they had the willingness. But Richard Fuld thought the price was too low. The Korea Development Bank had offered around $6.40 per share for a controlling stake, a price that included a 30% premium for management control. Fuld wanted £70.50 a share. Lehman was worth more than that, he insisted. This wasn't the moment to sell cheap. Negotiations dragged on for weeks. In early September, the KDB officially walked away. When the news leaked to the market, Lehman's stock plunged another 43% in a single day. The second offer came from Bank of America. In early September, Bank of America was seriously evaluating a full acquisition of Lehman. Strategically, it made sense. BofA would gain access to Lehman's global network. Lehman would get the lifeline it desperately needed. But Fuld hesitated on the terms. He wanted a higher price. He wanted better conditions. He was convinced Lehman still had bargaining power. While Fuld hesitated, something happened that changed everything. Bank of America discovered that Merrill Lynch, another giant investment bank also on the brink, was available. And Merrill Lynch, unlike Lehman, wasn't playing hardball. On the afternoon of September 12th, Bank of America officially walked away from Lehman and struck a deal to buy Merrill Lynch for $50 billion. But there was a secret that made everything even darker. While negotiating with potential buyers, Lehman had been concealing the true scale of its problems through an accounting maneuver called Repo 105. The scheme worked like this. Just before publishing quarterly financial results, Lehman would temporarily sell around $50 billion in toxic assets to other institutions, with an agreement to repurchase them shortly after. On paper, the bank looked healthier than it was. Once the report was published, the assets returned to the balance sheet. But investors had already seen the clean numbers. It was creative accounting on the edge of fraud. When the existence of Repo 105 was revealed, it destroyed whatever trust in Lehman still remained. If the bank was hiding $50 billion in liabilities, what else was it hiding? And then came the weekend that changed everything. Friday, September 12, 2008. Lehman's stock closed the day at $365 per share. In 2007, it had been worth $86. Rating agencies were about to downgrade the bank to speculative grade, which would automatically trigger massive forced liquidations. Lehman's biggest clients were pulling their funds at an accelerating pace. Richard Fuld spent the day on the phone, trying to convince anyone who would listen that Lehman could still be saved. Meanwhile, in Washington and New York, the U.S. government was in full crisis mode. Timothy Geithner, president of the Federal Reserve Bank of New York, called an emergency meeting for the weekend. And Henry Paulson, the United States Secretary of the Treasury, was flying to New York. At that point, Paulson had already communicated to Fuld that there would be no public money for Lehman. The message was clear. If Lehman wanted to survive, it needed to find a private buyer. The government would not provide guarantees. But why not? The Fed had guaranteed $30 billion to rescue Bear Stearns just 6 months earlier. Why was Lehman different? Paulson had an answer. Moral hazard. If the government rescued every bank that made bad decisions, banks would never stop making bad decisions. A message needed to be sent. And Lehman would be that message. It was as much a political decision as an economic one. Paulson, a former CEO of Goldman Sachs, was under intense political pressure. Bailing out Wall Street banks with taxpayer money was deeply unpopular, especially in a presidential election year. Saturday, September 13th. The Federal Reserve Bank of New York was flooded with the biggest names on Wall Street. In attendance, Geithner and Paulson representing the government, the CEOs of the largest American banks, Goldman Sachs, Morgan Stanley, JP Morgan, Citigroup, Richard Fuld representing Lehman, and Bob Diamond, the American CEO of Barclays, the British bank that had emerged as the leading potential buyer. Paulson was direct. No federal money for Lehman. The message was crystal clear. The private sector had to solve this problem. The biggest Wall Street banks needed to either pool money to absorb Lehman's toxic assets or find a buyer. Fast. Two possibilities existed at that moment. Barclays or, well, only Barclays, since Bank of America had just bought Merrill Lynch. Bob Diamond wanted to do the deal. Barclays had the capital. It had the strategic rationale. Buying Lehman would be a massive leap for the British bank into the American market, but Diamond needed government guarantees from the U.S. authorities. Without them, Barclays couldn't absorb Lehman's short-term obligations during the transition period. Paulson said no. The meetings went on through the night. Lawyers, bankers, regulators, hours and hours of conversations going in circles. At one point, late Saturday night, bankers were still wrestling over how much equity would be needed to make the Barclays deal work. Specifically, how to handle the toxic real estate assets Barclays didn't want to touch. Sunday, September 14th. The meetings resumed early. The pressure was unbearable. The markets were opening in less than 24 hours. Sunday morning brought a brief moment of hope. Everything was ready to go, one participant later recalled. People were happy with the term sheet. There was a doable deal on the table. A senior Paulson advisor even told Lehman executives, "It looks like we may have the outlines of a deal around the financing." The Lehman bankers thought they had saved their firm. They were wrong. The Barclays deal required the blessing of the Financial Services Authority, the UK equivalent of the SEC based in London. Paulson called his British counterpart, Chancellor of the Exchequer Alistair Darling. The FSA's answer came back decisively. They would not approve the transaction without a shareholder vote. A shareholder vote would take weeks. Lehman didn't have weeks. It didn't have days. It had hours. At around 9:45 Sunday morning, Paulson summoned Lehman's president to the New York Fed and delivered the news. Deal's off. The FSA has turned it down. At noon, Bank of America officially confirmed its Merrill Lynch acquisition. The second possible savior was gone. At 6 p.m., Paulson made the final call. No government guarantees. "I cannot use taxpayer money." At 9 p.m., Barclays officially withdrew. At 11 p.m., Lehman had no options left. Shortly before midnight, lawyers were preparing the Chapter 11 documents. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers filed for bankruptcy, the largest corporate bankruptcy in American history. $639 billion in assets, $619 billion in debts, 25,000 jobs gone overnight. 9:30 a.m. Monday, September 15, 2008. The markets open. The panic was immediate. Lehman's stock, which had closed Friday at $3.65, opened at 21 cents. Traders who arrived at their desks that morning described a sense of unreality. This couldn't be happening. A 158-year-old bank. A bank with $639 billion in assets. The Dow Jones plunged 504 points by the close of trading, a drop of 4.4%. It was the worst single-day loss in 7 years. But the real horror wasn't in the stock market. It was in the credit markets. Credit markets are the bloodstream of the modern economy. That's where banks lend money to each other, where companies borrow short-term funds to make payroll, buy inventory, keep operations running. If the credit markets seize up, the economy stops. And on that Monday, the credit markets froze. The LIBOR-OIS spread, which measures stress in interbank lending and normally sits around 0.1%, exploded to 3.65%. Banks stopped lending to each other, completely. The commercial paper market, where companies borrow for ultra-short-term needs, collapsed. American companies couldn't secure financing for basic operations. It was as if the heart of the economy had stopped beating. Tuesday, September 16th. The day after Lehman fell, the world discovered there was an even larger bomb about to go off. AIG. The American International Group was the largest insurance company in the world, a colossus with over $1 trillion in assets. But AIG had sold an astronomical amount of credit default swaps, essentially insurance contracts against the default of financial securities, including the very same mortgage-backed securities that had destroyed Lehman. When Lehman collapsed, those insurance contracts were triggered simultaneously by banks all over the world. AIG had no way to pay. If AIG failed, the banks that had bought those contracts, banks in the United States, Europe, and across the globe, would suffer catastrophic losses at the same moment. It would be the end of the global financial system. This time, Paulson and Bernanke made a different decision. The Fed injected $85 billion of emergency funding into AIG to prevent its collapse, a number that would eventually climb to $182 billion. The same logic that had been refused for Lehman, using public money to bail out a financial institution, was applied to AIG the very next day. The inconsistency did not go unnoticed. If Bear Stearns had been saved and AIG was being saved, why hadn't Lehman been saved? Who would fall next? Nobody knew, and that uncertainty was pure poison for the markets. Wednesday, September 17th. The Reserve Primary Fund, the largest money market fund in the United States with $62 billion in assets, announced that it had broken the buck. Breaking the buck is a term for when a money market fund, which theoretically never loses money, falls below $1 per share. It's like discovering your savings account can go negative. This was not supposed to be possible. The reason? The fund held $785 million in Lehman Brothers debt, now worth nearly nothing. Investors around the world rushed to withdraw their money from money market funds. Within 24 hours, over $200 billion in redemptions had been filed. People who believed they had safe, stable savings discovered they didn't. The panic was spreading beyond Wall Street. It was reaching Main Street, the bank accounts of ordinary people. Thursday, September 18th. Morgan Stanley and Goldman Sachs, the two surviving giants of investment banking, watched their stocks melt. Morgan Stanley lost 25% in a single day. There were rumors the bank might not survive the weekend. Goldman Sachs, considered the most sophisticated institution on Wall Street, was in controlled collapse. Within days, both banks applied to convert themselves into bank holding companies, a status change that gave them access to the Federal Reserve's protection umbrella. It was a symbolic surrender. The independent kings of Wall Street asking the federal government for protection to survive. ATMs were still working, but for how long? Friday, September 19th. Henry Paulson and Ben Bernanke went to Congress. They didn't come with a polished presentation and neatly organized data. They came with an existential emergency warning. Bernanke, the world's foremost scholar of the Great Depression, the man who had spent decades studying exactly how to prevent a catastrophe of this kind, looked at the assembled lawmakers and said the words none of them had ever expected to hear. If we don't do this today, we won't have an economy on Monday. The room went silent. They were asking for $700 billion. The Troubled Asset Relief Program, TARP, an emergency rescue on a scale never before attempted. The idea was for the government to purchase toxic assets from the banks, cleaning their balance sheets and restoring confidence in the system. Paulson, the former banker who had refused to save Lehman on grounds of moral hazard, was now reportedly on his knees, literally begging lawmakers to approve the largest financial rescue in American history. The world had changed in a single week. When the dust settled, the world tallied the damage. The numbers were staggering. Lehman Brothers left behind a hole of $619 billion in debt. Its creditors, banks, pension funds, individual investors from around the world, waited years to learn how much they would recover. The answer, when it finally came after more than a decade of legal proceedings, was brutal, approximately 21 cents on the dollar. For the global financial system, the losses were on a different scale entirely. Roughly $10 trillion in market value was wiped out across the world's stock exchanges in the weeks that followed. 12 of the 13 largest American financial institutions came close to simultaneous collapse. Merrill Lynch was sold in an emergency to Bank of America. AIG was bailed out with $182 billion. Citigroup required $476 billion in guarantees and capital injections. Bank of America itself received $45 billion in TARP money. Morgan Stanley and Goldman Sachs survived, but only because the government ultimately decided that moral hazard was a smaller problem than the total collapse of global capitalism. The $700 billion TARP was approved by Congress. The same chamber that had rejected it on the first vote approved it on the second, terrified by what it was watching in the markets. The total in bailouts, guarantees, and government interventions eventually surpassed $12 trillion. And the real economy? The Americans who had never heard of credit default swaps or Repo 105 paid the highest price of all. 8.7 million jobs were destroyed in the United States between 2008 and 2010. 10 million families lost their homes to foreclosure. The recession that followed, the Great Recession, was the worst since the Great Depression of 1929. Economic growth collapsed globally. Countries that had never heard of Lehman Brothers felt the impact. And the men who made the decisions? Richard Fuld was called before Congress to testify in October 2008. He sat in the witness chair and said he had done everything right. That Lehman had been destroyed by a crisis of confidence that had spread through the entire system, not by his specific choices. But then he said something surprising. With the benefit of hindsight, I would have done things differently. Yes, I would have. In 2010, he testified again, this time arguing that Lehman could have survived if the government had given it the same support it gave Morgan Stanley and Goldman Sachs. He blamed the Fed, he blamed the Treasury, he blamed the market. Fuld lost more than $1 billion in the value of his Lehman shares. He never worked meaningfully on Wall Street again. Henry Paulson, in the years that followed, defended his decision not to save Lehman as necessary to avoid moral hazard. But he later admitted something revealing. He wasn't certain he had the legal authority to save Lehman even if he had wanted to. The Fed could extend credit to institutions with adequate collateral, and Lehman's collateral was deemed insufficient. TARP, approved afterwards, gave the government that power. But it came too late. If Paulson genuinely couldn't save Lehman, the tragedy deepens. It wasn't just a flawed political decision. It was a system that arrived at the most critical moment in its history without the tools needed to handle it. What does this story leave us with? It leaves us with the image of 25,000 employees walking out of the Lehman building on the morning of September 15th, cardboard boxes in their hands. People who showed up to work on a Friday as employees of one of the world's greatest banks and came back Monday morning only to collect their belongings. It leaves us with the certainty that Lehman could have been saved. This isn't speculation. There were willing buyers, there was capital available, there was time. The opportunities existed between June and September 2008. They were wasted, one by one. Standard plus one. It leaves us with a lesson about corporate pride. Richard Fuld spent months refusing sales because he believed Lehman was worth more. When bankruptcy finally came, creditors received 21 cents on the dollar. Any sale, at any price he considered too low, would have been better than that. It leaves us with the inconsistency that created panic. The government saved Bear Stearns. It let Lehman fall. It saved AIG the very next day. That lack of clarity about who would be rescued and who wouldn't generated a terror that even the bailouts couldn't extinguish. It leaves us with a reflection on impossible deadlines. Decisions with civilizational consequences were made in 48 hours, in a race against the clock over a single weekend. The timing, the fact that negotiations collapsed on a Sunday night, with markets opening in hours, was fatal. And it leaves us with a question that historians and economists still debate. Did Lehman's bankruptcy cause the 2008 financial crisis? Or did it simply accelerate a crisis that was already inevitable? The honest answer is, probably both. The system was sick before Lehman. But Lehman was the moment the fever became septicemia. 158 years of history, destroyed in a weekend. Multiple decisions, all wrong. At the most important moment. Lehman Brothers was not just a bank that failed. It was the mirror in which the financial world saw itself, and didn't like what it found.